Slideshow from beginning. So while we discussed the liability section of the financial statements last week, we're going to talk in depth about the stockholders' equity section. Again, if we don't talk about it here, you're not going to see it. And really focus on terms, and we're going to have one problem that we'll do a similar one in class. So basically, when we're dealing with corporations, which is the form for most businesses in the United States are in the form of a sole proprietorship, the volume of businesses. But the ones with the largest assets and the largest revenues are generally in the form of a corporation. Now, corporations are separate from its owners. It's considered a separate legal entity, and there are purposes. It can be a not-for-profit or it can be a for-profit. Can anyone think of a large not-for-profit that is a corporation? United Way, Red Cross, Goodwill, Salvation Army. The purpose of that company is not to make a profit because they do not have shareholders. It's to serve the citizens. It's to serve either internationally or nationally to help out people for a specific cause or purpose. Okay? For-profit organizations are created to make money. Totally different facet in how they conduct business. So, for-profit, IBM, Facebook, Caterpillar. How does Facebook make money, guys? Do you pay for it? Advertising. How many of you guys look at those advertising though? When you're on Facebook? Maybe it's in a subtle way that we are drawn to it, but I might buy things as far as some of those games go, but I don't really focus on those ads. But for whatever reason, it's a huge company because of the draw and the number of people that those advertisements can reach. Facebook, IBM, Caterpillar, GE, these are all public companies for profit. Then there are companies that are publicly held, such as the Facebook and the IBM. And then there are some that are what's called privately held. They aren't, they're not open to all of us being able to buy shares in. Coke Refinery or Flint Hills Resources is a privately held company. Can anyone else think of offhand of a privately held company? Anyone? Your presentation, they will all be publicly held companies. Because when you're dealing with privately held companies, you're probably going to have a hard time finding information on their revenues and sales because they're not required to report them. Okay? Characteristics of corporations. They are a separate legal entity. There's the stockholders that choose to invest their money in the company, their liability is limited just to the investment they have in that company. Unlike sole proprietors, when a sole proprietor begins a company, they have what's called unlimited liability. So I provide a service to Martin. Martin is harmed by my service. Martin can sue me not only for what he was harmed, he can come after my personal assets to get compensated. With stockholders in a corporation, you're limited to only your investment in that corporation. The benefit of a corporation is with a sole proprietor, the income or the ability to raise capital is with one person. So I might have limited resources in order to raise capital for a particular purpose. But if we've got 100 of us together, or 1,000 of us together, or 1,000,000 of us together, it's a lot easier to raise money because there's more heads, and as a result, more money and money helps bring in more money. The continuous life, a corporation doesn't die or end just because a shareholder dies. It continues indefinitely because someone else will acquire that stock or it's inherited. What are disadvantages of a corporation? Sometimes the management can have ulterior motives or incentives that aren't for the best interest of the corporation. There can be a ton of government regulations related to corporations, and it's generally speaking, they pay a higher tax than do individuals or people that are individuals that where the profits or earnings flow back to their personal return. Another thing here, corporation acts, the separate legal existence. This is be a good one to have matching with, guys. The separate legal existence is that the corporation acts under its own name rather than the names of the shareholders. So this corporation can purchase buildings just like an individual can purchase a building. The corporation can transact business in ways just like an individual can transact business. A corporation cannot vote, okay? But for purposes of a separate entity, the corporation can act on its own. Limited liability of stockholders means their investment, the liability is limited to their investment. And this is online too, guys. Transferable ownership rights, the shareholders can sell their stock. They're not stuck with this company. The ability to acquire capital, based on issuing more stock, they have the ability to raise funds in order to either create new services or manufacturing or patents. Continuous life, just because a shareholder dies doesn't mean the company has to die with it. Now, a negative here, corporate management. Separation of ownership and management prevents owners from having an active role in managing the company. So the corporate management means the company is going to hire people to run the ship. And the shareholders, the people that own the company, might not be the ones that are running the ship, okay? Because the board of directors is responsible for making sure the company has an effective management. Government regulations. There are all kinds of laws. Depending on what type of company it is, you're dealing, and especially if it's a public company, you're dealing with the Securities Exchange Commission. If you're operating under a state, you have to adhere to the state guidelines, the federal guidelines. If you're an airline, you have to deal with the FAA's guidelines. If you're in a drug company, you have to deal with the Food and Drug Administration guidelines. So there's so many various responsibilities. As you get bigger, you've got more structure to adhere to. And then taxes. Not only do corporations have to pay income taxes, but then when they choose to issue dividends to their shareholders, the shareholders have to pay taxes on those dividends. So sometimes they call that a double tax, where there's a double taxation, because they pay taxes on the earnings, and then when they share and pass those earnings to the shareholders, they have to pay taxes. The shareholders pay taxes again. Here you see an organizational chart of a corporation. It starts with the stockholders, and the stockholders are represented through the board of directors. And then from the board of directors elects the president and chief executive officer, who are basically part of running the company. And then from there, the president and CEO are going to have upper management guiding the company via the attorney of the company, the marketing piece, the finance piece, the operations, and HR. Generally, companies are broken into various segments to run specific aspects of the company. Then from the chief financial officer, you've got your treasurer and you've got your controller. So this is generally the hierarchy, the organizational chart up at the top of a corporation. So with companies, corporations are the largest type of company, but there are others available. Limited partnerships is another form of a company. There's a limited liability partnership, but the common one we're familiar with now for the past 10 years has been LLCs, limited liability companies. The beauty of an LLC is it has limited liability just like a corporation has, but it's taxed at the individual level. So the LLC does not pay income taxes. Those profits flow back to the various members of the LLC, and they pay taxes at their level. An S corporation is what I am. A lot of small businesses where there's 1 or 2 or 5 shareholders form what's called an S corporation, where again my profits flow back to me personally on my own personal tax return, so I don't have to pay it at a corporate rate. How do you form a corporation? You take an application out with the Secretary of State of the state you wish to be incorporated by. So even though the headquarters of Target may be here, my guess is Target was incorporated in Delaware. Delaware has certain privileges and security issues and ease of formation that encourage a lot of companies to form their corporation in Delaware, even though they might operate in a different location. Stockholders' rights. Stockholders have the right to vote the board of directors, and they also have the right to share in the earnings. Now, they just can't say, hey, you guys made money this year, I want some. It's got to be elected by the board of directors to actually choose to provide dividends, but those are their rights as stockholders. Let's just say right now I have 100 shares of 1,000 shares of a particular company. They have the right called preemptive right. When, let's say this company is going to issue another 100 shares, I have a right to keep my percent in the company the same. So I have the first right of refusal to be able to take a certain percent of those new shares. So if I have 14% stock in the company and they're choosing to issue new stock, then I have the right to receive and pay for 14 shares of those new 100 shares of stock. So my percentage in the company stays the same. Make sense? Anyone have questions?
You have to buy those, but you have...
Absolutely, you have to buy them, but you have the right to keep that same percentage of stock. Okay, you have the first right in that. Now, let's say a company goes out of business. Usually they go out of business because they go bankrupt, but if they go out of business, the shares basically, after they pay off the creditors, the money left over gets to go back to the stockholders. Basically, it's returning your money, your investment that you put into the stock, basically. Authorized stock, okay, when a company applies for an application with the Secretary of State, in that application, that application, or charter as they call it, shows the amount of stock the corporation is authorized to sell, to put out there. Now, the number of authorized shares isn't always the number of shares issued. So no, they might be authorized to sell up to 1 billion shares. But currently they may have only issued 100,000 shares. Authorized is the amount in total they're allowed to issue. Okay? Know there's a difference between authorized and issued. Okay? Here is a stock certificate. You don't see many of these anymore because everything's become electronic. But this stock certificate shows the Franklin Life Insurance Company certifies that this individual is the owner of 100 shares of the with a par value of $2 each of the Franklin Life Insurance Company. Okay? So you actually receive a stock certificate showing your ownership in the company. You see, as it shows, these stock certificates get pre-numbered. It's always going to show the name of the company, who owns these shares, the signature of the official of the company, and how many shares you own. Okay? So if you had a question of what is on a stock certificate, you would know these items. So corporations then are authorized to issue so many shares of stock. But who do they issue them to? Well, they can issue them directly to the people that are supporting their endeavor, or they can go through a specific company like Goldman Sachs or Barclays that will promote their company. And so they pay a fee to this investment company to go out and secure investors to help invest in this company. So they in turn, basically the Goldman Sachs is a conduit for finding investors who have money, who are interested in a startup company. The exchanges that do trade stock, the main one we know is NASDAQ and New York Stock Exchange. There's a London, Tokyo, and I'm not real familiar with this Euronext, but these are the 5 stock exchanges in the world right now. The New York Stock Exchange is by far the largest. Okay, so how are you guys doing? You want me to take a break?